Today let's discuss the recent rally in the dollar INR to an all-time high of 89.53. The rise has been strong, but the momentum now looks stretched, and the question is whether this move is close to slowing down, especially as the RBI may step in if the volatility increases further. The main pressure on the rupee has come from large foreign portfolio outflows. Investors have pulled out more than $16.5 billion from Indian equities this year, marking the currency move more vulnerable. Sentiment has also been weak because the US India trade deal is taking longer than expected, creating uncertainty for businesses and investors. The trade sector has been under stress ever since the US imposed higher tariffs on Indian exports in late August. Exports have dropped 9% year on year, and the trade deficit has widened to a record level. Upcoming trade numbers may still reflect this weakness, even though India's domestic economy remains strong and equity markets are near record highs. The rupee continues to face pressure due to these external challenges. On the policy side, softer inflation increases the chances of an RBI rate cut. Earlier expectations that of a US Federal Reserve cut would keep the earlier the expectation of a US Federal Reserve would keep rates unchanged were putting extra pressure on the rupee, but with the US rate cut expectations rising again, the interest rate gap between India and the US may narrow, giving the rupee some relief. Given these factors, dollar INR may experience support near 88.80 level, which was used as previous resistance zone. The upward moving channel in the long term showing the next breakup level is pretty high above 90, which looks less possible. The lower line of the channel can lead to a breakdown in the pair and see further rupee gains. With the pair at very high levels, some short term correction is also possible. So coming to the recommendations, exporters can consider selective hedging, covering 30 to 40% of their hedge ratio while avoiding heavy coverage at elevated levels, especially since dollar INR premiums are currently on the lower side. With the upside now open in the pair and the all-time high at 89.53, some RBI intervention may be seen around these levels. And for importers, they should remain cautious. If the stop levels are set, they should be followed strictly, and importers may look to hedge on dips below 89 and consider increasing their hedge ratio near the short-term support zone of 88.80 to 88.90. So concluding the video, overall the trend is still upwards, but the move is becoming more technical than fundamental. Watching the Fed comments, RBI policy signals and upcoming trade data will be key for understanding the next direction in dollar INR. That's all for this video on dollar INR. Thank you for watching.